Hey everybody, I hope everyone's doing well and had a good day. This is a brief recap of the Emini 5-minute chart for Wednesday, December 4th, 2024. If we look at the daily chart, if we could only see the bars shown on the screen and we did not have the big picture, what is this pattern right here? We would see a tight bull channel. And let me see if I can quickly draw. Maybe it's drawn something like that. The lines don't have to be perfect. The point is the market is trending up. The bull trend line and the channel line, so the line below the support, that's the trend line. The trend line and the trend channel line, the line above, resistance, they're close together. And the channel is sloped upward. So we have a tight bull channel. If we look at the selling pressure, we have dojis, we have some bear bars, but we have many more bull bars than bear bars. The bear bars, big tail, small body, big tail below. Bull bars closing near their highs, consecutive bull bars. The point is, it's more bullish. We're above the moving average. So there's no reason to sell. And I say there's no reason to sell. It's not really true. There's always a reason to take the opposite side of a trade. But when the market's in a tight bull channel, do I really want to be looking for shorts? Probably not. If it's a tight bull channel, I know it's a breakout on a higher time frame chart. Therefore, I only want to look to buy. If you've listened to Al long enough, if you listen to Al in the trading room, you'll hear him talk about things in that way. Tight bull channel, only want to buy. And that's a mental system that he has created. And it reminds him, if the market's in a tight bull channel, I'm only looking for buy setups. What's the point of all that? Because this is the context we had going into the day. We have a couple of dojis here, but again, tight bull channel. So until the bears have a decent trendline break, I'm not too interested in selling. Now, if we go to the 5-minute chart, going into the day, we have a gap up, back up just a little. I think the gap up is important. We actually gapped up above the past 2 days, and if we look, it's a fairly tight trading range over the past 2 days. Then we gapped up, bull bar, bar 1. So let me just back up one more time. This blue line, actually that's not quite right. This blue line is yesterday's high, and it's the high of the tight trading range from the past 2 days. These two bull bars right here. We gapped up far above both of those highs, so the market's breaking out. Every trend bar is a breakout, climax, or gap. And so this gap up, you can see it as a breakout. You can see it as a climax, but the point is there's a space between the high of the range and the close of bar 1. And now typically I like to look at the Globex session to see what the market actually did. Was it a trading range? Big up, big down, big up. In this case, I guess we can look really quick. We had a pretty tight rally. Let me see. So here's basically what we had going into the day. So again, it's a tight bull channel, just like on the daily chart. So traders are looking for buy setups here. We're looking for reversal attempts to fail. Tight bull channel, trend line break, bears hoping for double top, major trend reversal, but no bars below the moving average. The retest was too strong. There's no stop order sell. We get another strong leg up. The process repeats. So that's the context going into the day. Now, why am I saying all of this? Because the gap up was significant. Price is far above the trading range. Here's the high of the trading range. We're far above it. The gap up is probably going to get a second leg. So that's the context going into the day. Gap up, follow through bar 1. It's a bull bar. The bulls did the bare minimum, which is preventing a bear body. And here's what we had today. We had a fairly tight trading range on the open. First 6 bars, up and down, lots of overlap. It's breakout mode. The bears had a breakout attempt early on bar 7. And I know I'm supposed to keep these ones quick, but I like to explain in real time, looking as if it's real time, so we cannot see the bars to the right. Bars 6 and 7. 6, big tail below, so we sold off, pulled back. 7, a big bar. You can call it a bear trend bar, but there's a big tail on the bottom. So we broke out to a new low of the day. Let me snap that. We broke out below bar 1, but could not close below bar 1. Consecutive bear bars, 6, 7, big distance from the high of 6 to the low of 7. The odds are 6 and 7 will get a second leg down. The problem is that it's a tight trading range. Breakouts typically pull back very deeply, if not reverse. So my expectation after 6 and 7 is a deep pullback, and then maybe a second leg down. Depends on the strength of the reversal by the bulls. But generally, I'm not looking to buy after 2 big bear bars. I'm typically waiting for a second reversal because I think the bears will get a second leg down. Again, we'll probably bounce first and get a deep pullback because it is 2 legs down, 6 and 7. It's minor, it's on a smaller time frame, but that will create some support. So my thoughts here, probably sellers above 7, second leg down, but this does not look like an impressive bear breakout at this point. Remember what I said. Let's take the opposite of what's happening going into the day. Trading range price action. This blue line is the high of the trading range. We gapped up and had follow through. We're closing way above that resistance. Take the flip side. Breaking out to the downside, or at least attempting to. But in this example, the support, the red line, is equivalent to the blue resistance line. It's better for the bears if price can close far below support, but in this case we broke below support and then rallied. Support and resistance are never exact. It's sort of a field. You know there's probably support somewhere in this area. That doesn't necessarily mean you're going to bounce at the one low exactly. That's why you can get lower lows, lower low double bottoms, higher low double bottoms. But the point is, strong breakout up far above this trading range probably will get a second leg. Weaker breakout below here. It's minor. First of all, the bull breakout is much bigger than the bear breakout. So this might be an expanding triangle bull flag. High, higher high, low, lower low. But in any case, let's continue so you can see what happened. Deep pullback on bar 9, testing way up here. The bears getting a second leg down. 1, deep pullback. 2, probably buyers below 7. Why buyers below 7? Some unfortunate bear sold the low tick of bar 7. And then we got bar 8, bar 9. So if you sold down here and the market pulled back this far against you, you may have scaled in. Whether you scaled in or not, you're probably disappointed with your first entry, and you look to exit around your first entry. So that'll create some support below bar 7. That's one reason. Then you have bar 1, bar 7 low, 1, 2, maybe 3 pushes down, possible wedge. So there's reasons for support. Then if we go lower, we got moving average, we still have the gap. And then bar 10 tested lower. And again, I'm going back into my old ways. I need to speed it up, but this is a good example. Bars 10 through 15, bull micro channel. So we have a 6-bar micro channel. We have mostly bull bars. That's good for the bulls. Only 1 bear bar, and it's weak. And price moved a big distance from the low of 10 to the high of 14. This rally will probably get a second leg up, even if it pulls back first. And it might get a deep pullback because look at the context. We've been sideways for 15 bars. In trading ranges, breakout points close. We get deep pullbacks and delayed second legs. Where's the breakout point? Well, the first one, we could say, first of all, the leg began here and may have ended here, but we have a breakout bar 13, breaking above the highs of 12 and 11, and creating a gap from these prices to this close. So this is going to be a target for traders who sold above bar 11, got trapped, they're disappointed with the rally, they're looking to exit their shorts at break even. You also have bulls who did not take the buy, they missed the rally, they're looking to buy a pullback, catch a second leg up. Then you also have the higher time frame context. We know the Globex 15-minute is in a tight bull channel. We had a gap up. Gap up is a breakout, typically gets a second leg. Is this the second leg? It might be, but it also still might just be an expanding triangle flag. So maybe we have a gap up, breakout, attempt at trend resumption. Maybe it's part of the pullback. We pull back again and then get a second leg. But the bulls did their minimum. I think technically the bulls did their minimum on bar 6 when we had a gap up, the breakout, a pause, implied pullback, second leg to a new high. So bulls did their minimum, but now we need to see the bear reversal attempt. How strong are the bears? Is this an expanding triangle, major trend reversal? Is this going to be the high of the day and we trend down for the rest of the day? 16 bear bar, but big tail below, so we sold off, we rallied, bad context. It's after 6 consecutive bull bars or a bull micro channel, and we're testing a breakout point. And 17, second leg down for the bears. 1, pullback, 2. 17, classic second leg trap. The bar looks stronger than 16, but the context is bad, and it's a sell vacuum testing support. Looks like we may have tested even below the 12 high, but you can see we're testing this area, the breakout point. This is expected to get a second leg up, and then you can see what happened. Buyers at the breakout point, second leg up. Bulls did their minimum. We got above 14. There will be profit taking because we're channeling. So bulls buy pullbacks, take profits at new highs. Tight trading range through here. Tight trading ranges give a lot of information. Tight trading ranges tell you the price was fair. Bulls and bears are taking trades through here. Both are scalping, making money. And they're doing this knowing, basically they're fading breakout attempts, selling above bars, buying below bars, doing this knowing that at some point one side is going to get trapped. The bulls, they get trapped buying below any of these bars, maybe below 39. But it's clear we went far lower than this range. Bulls buying down here got trapped. This bear attempt will probably get a second leg down. One issue I have with that is we had a low, lower low, now a climactic third push, lower low. So it's a breakout of a bear channel. Plus, look to the left. Remember I said on 7, some unfortunate bear sold the low tick of 7. Some unfortunate bear sold the low tick of bar 10 as well. So we have trapped bears still down here. A bear sold here. We rallied all the way up here. They scale in higher. And let's just say they take a stop order sell. They sell the low tick. Unlucky. They sell more below 42. A bear bar. Top of the range. And now they're at a profit. They're at a profit on their first entry, they're at a loss. On their second entry, they're at a profit. This line would be break even on the entire trade. Here, they're at a profit, offsetting this loss. Our bears who sold here and held through a 40 bar pullback, are they going to be desperate to sell down here again? Probably not. It looks like this is the bottom of a trading range, and this might be a climactic test of the bottom. Big picture, big gap up, one reversal attempt, a second reversal attempt. This could be shaping up to be a double bottom bull flag, high 2 in a bull trend on a higher time frame. But the reason I highlighted the tight trading range in green here, it's an area of agreement And typically breakouts of trading ranges typically do not go far before they're retested. The midpoint of this range is going to be a magnet. Bears not selling down here because every time we got in the lower third, we found support. It reversed up. Bulls buying for the exact same reason, and then we get this. It's a surprise. So you have bears who did not sell. You have bulls trapped, both looking to sell but at a higher price. Bulls getting trapped into a losing trade, hoping we rally. Bears missing the sell-off, hoping we rally, both looking to sell a deep pullback. So that's why I wanted to talk about that area of agreement, because yes, we had this breakout, but we're still not below all the bars to the left, and it's an overall more bullish environment. And then look at bar 50. Terrible bar if you're a bear. You sell to close 49, which you can do, but the bar's getting much bigger, 49. Overall context looks like a trading range. You really need momentum. If you're selling 49, you need the market to just plunge down. You need a duplicate bar. You need basically a photocopy of 49 on 50. If the market stalls and hesitates, traders will be really quick to exit their positions, because the bears who are selling, say they're selling the close, the stop goes way up here. You could say the top of the bear leg, maybe here, maybe even just this bar. But if you think about what Al talks about, stop goes here, you're selling here, 1 times your risk is down here. What are the chances we get down here before back up here? And you judge probabilities based on momentum and context. You're at the bottom of a trading range. That's not good for the bears. But it looks like you have momentum. If the momentum continues, we'll further trap bulls, we'll go lower. But then we get 50. And 50 dramatically changes this trade. If you did sell to close 49, you wait for the next bar to close, 50 is a problem. If you're lucky, we'll retest the close of 50 or 49 before we rally, but now we have a sell climax, possible late leg, bottom of a trading range with a tight trading range above, so magnet, and then a bull bar closing on its high. The odds are, now at this point, we're going back here, the top of the sell climax. Traders will buy above this bar. Bears will exit shorts, thinking they're in trouble. Bulls will buy, thinking we got to test higher. And we got there in a hurry, and you can see right when we got there, there was some selling. We actually tested the top of the range. This breakout, even stronger than this one. This likely to get a second leg, climactic reversal, leg 1. You can call it a big leg 2 because it's a double bottom, but it doesn't matter what you call it. It's a strong bull breakout, crossing the moving average, 4 consecutive bull bars, all of them closing on their highs. With little overlap, we've opened gaps, and we have trapped traders below. So traders will buy a bar like 54 because it's the first bear bar in 4 bars. The context is not great for selling because you still have trapped traders below. Best case scenario, and I don't even know if the bears got it here, you sell to close 49, sell more below 54, and hope you exit at break even. And the bears actually did not get it. The bears took a loss here for sure. Well, the sell to close bears here, entering with stop orders. To be fair, if you were, let's say you sold here and then sold more actually above the sell climax, you sell here, you make a mistake, you're slow to exit, use a very wide stop, and you actually scale in, sell more above 47, which you can see traders did. You can see where we tested. This is the average price. If you had sold the close 49, scaled in, sold more above 47, and then just took break even on the entire trade. And those bears, I want to get this point across. Bears who sold down here are trapped. And if you're short and you start getting this, you're desperate to get out. And you'll try to do anything to avoid a loss. So I'm going to demonstrate it one more time. You sell more here, scale in, and you just take break even on the entire trade. Those desperate bears, when I say the word desperate, I think it's important to understand that, because when there's a sense of desperation, there's a sense of urgency, there's a sense of, if you put yourself in the shoes of the bear who sold here, there's a sense of anxiety. You sell here only to watch the market do this. You're just hoping the market comes back even a little bit to make the loss a little bit smaller. And you can see exactly where it went. Markets are really well behaved like that. And it's not going to be exact to the tick every time, but it's pretty close. You sell here, scale in, yep, trader sold. Looking to get out break even, yep, right around this line. And that is what leads to a second leg up. So when there's desperate bears, the bulls are licking their chops. The bulls say, we got you, bears. You're trapped. You're going to be forced to scale in, exit at break even if you're lucky. Bulls will buy here and scale in lower, knowing there's a high probability they get a second leg up. And in this case, it was a pretty tight channel that lasted pretty much the rest of the day. All right, I'll add one more thing. This is a little bit climactic. We have been in this channel for quite a while, and now we're getting acceleration, and that's characteristic. When you have a sign of strength, I call it strength, but it could easily be exhaustion. When there's an increase in momentum late in a channel, it typically leads to a pullback. It doesn't necessarily mean a reversal, but it might attract profit taking for the same reason I said about the bears here. It's the trader's equation. We just focus on, I really just want to focus on these bars right here. If you're a bull and your stop is below the bottom of the bull trend, the rally, and you're buying here, 1 times your risk, way above 6,300. You can only buy here, stop down here. You can only be willing to buy here if you're at least 60% certain the market's going here before here. If it starts to pull back, go sideways, you're going to be quick to exit because you're paying far above the average price for an unrealistic target. And the reality is we had a deep pullback here, the rally, lots of, where are the big consecutive bull bars? It also might be a late leg. It's really just not great. Not the greatest place to buy here. The bull's hoping for a surprise, but I think more likely we'll pull back fairly soon. And I want to make sure I'm explaining that thoroughly. If you are a bull and you're buying here, and it does not matter, there's no such thing as other people's money. So I don't care if you bought the low tick down here and you're holding long. That's no different than turning on your screen, sitting down, you're flat, and then you just buy the market and you're long here. There's no difference. It's the same trade. So you buy here, stop down here. You can only take the trade if the momentum continues and you're sure we're going up here. And if you're not sure what happens, the risk gets big and you're a trader, the hedge fund risk manager comes around and taps you on the shoulder and says, hey, make sure your risk is under control because your stop is very far. And what's the probability we're going here before here? And I cannot be 60% certain of that. So any sign of hesitation, traders will be quick to exit. I mentioned we're far above the average price. And this happens all the time. If you get a bear bar closing below its midpoint, closing on its low up here, that's the bar I think traders have to get out below because we can easily sell off quickly to the moving average where traders will look to buy again or some other support. Maybe it's a breakout point, but whatever the case is, the point is the risk gets big. Traders have to control their risk. The easiest way to reduce risk is to take profits. And if enough traders start taking profits, we stop going up, we start going sideways. The bulls lose momentum. We're still far above the average price. The bulls are overpaying. We have to go lower to find buyers. So I hope that makes sense. And that's all the time I have for this video. So really appreciate everybody watching. And I hope that was helpful. And I hope everybody has a good night.